64. That is the critical figure Wall Street desperately hides from your view. It marks the S&P 500 peak in early 2026, Dow hitting 43,000, NASDAQ crossing 17,000, all indices at all-time highs. It appears to be prosperity, but it is actually a looming fiat disaster. Currently, trillions in pensions funds and life savings are trapped at the market's precarious peak. Wall Street chants their Ponzi mantra, everything is fine, buy the dip, stocks only go up, the Fed's printer will save us. But bubbles don't burst when the herd is fearful. They implode exactly when the sheep feel safest. Behind the curtain, the reality is stark. Funds aren't buying the hype. They're buying hedges. Insider selling is hitting record speeds. The smart money is exiting paper while urging you to buy the bag. That isn't confidence. That is classic distribution. Here is the brutal truth investors rarely hear. Real crashes don't start with panic. They start with pure optimism. Headlines cheering records. Analysts claiming this time is different. Retail convinced every dip is a buying gift. That is precisely the cliff edge we stand on. No, this isn't a new bull run. It is the death throes of the old cycle, a phase of insane concentration, max leverage, and blind faith in a few tickers to prop up the scam. When markets get here, history guarantees one outcome, and it is never pretty. The next phase won't feel like a crash initially. It will feel confusing, volatile, deceptive, until the floor suddenly vanishes. I will walk you through the precise pattern that precedes every historic collapse, showing you why in 2026 the script is running in real time. The question isn't if the paper market breaks. It is whether you spot the terminal signals before the herd gets slaughtered. Type 1 to proceed to Chapter 2 now. Type 2 to end the session here. If this view helps you see the rig, clearly subscribe to the channel and comment 1 below so I know to dig deeper. Every fiat collapse starts the same way with reassurance. Suits smile on TV. Headlines hail resilience. Dips are called healthy. The tone is calm to keep your capital trapped. In early 2026, the PSYOP message is clear. Absolutely nothing is wrong. History reveals a dark truth. When risk is low, markets don't need hype. They move quietly. Volatility is dead. Normies aren't discussing stocks at dinner. Today it's the opposite. Mania is extreme. Confidence is total. That mix always ends in ruin. The S&P 500 isn't a healthy market today. It is a narrow tower propped by a few giants. 7 stocks. Apple, Microsoft, Nvidia, Google, Amazon, Meta, Tesla make up 30% of the index. Let that sink in. A third of the market hangs on just 7 names. This concentration is abnormal. It is unsustainable. It fakes strength while hiding the rot. Hundreds of tickers are silently crashing. Many topped out months or years ago, but since the big names pump, the index hides the real damage underneath. This is why retail feels confused. Portfolios aren't matching the headlines, yet they are told to hold, ignore the noise, and trust the rigged system. What they aren't told is that smart money sees a completely different reality. In healthy markets, leadership rotates. Risk spreads. In fragile Ponzi's, leadership narrows. Capital herds into safety right before the rug pull. That is happening now. The trades are crowded, the assumptions shared. Everyone assumes a greater fool exists. Markets don't fail due to high prices. They fail from lopsided bets. When the whole herd is on one side of the boat, a tiny wave is enough to tip everything over. The warning signals aren't subtle anymore. They are simply being ignored by the greedy. After 50 years of chart watching, one truth remains. Prices change, tech evolves, but human nature never does. That is why every fiat collapse follows the exact same structural pattern. Not sometimes, every single time. There are 4 distinct stages. Miss them, the crash shocks you. Spot them, and nothing about it is a surprise. Stage 1, euphoria. Logic leaves the building. Prices detach from reality. Valuations stretch beyond any earnings or growth justification. No one cares. Price is the proof. Green candles convince the herd they are geniuses. Wealth feels real. Risk seems theoretical. Gambling replaces investing. Debt explodes. Margin climbs because leverage works until it kills you. Anyone questioning the bubble is mocked as a dinosaur, a doomer, or too dumb to get the new paradigm. Sound familiar? Stage 2 is the danger zone. The index rises, but participation dies. Breadth rots. Leadership shrinks. Gains focus on a few names while most stall or drop. Insider selling spikes. Volatility creeps up. Smart money doesn't panic. It quietly stacks protection. This stage is a trap because indexes hit highs. To the casual sheep, it looks fine, but underneath the structure is crumbling. It is like a building looking solid from the street while the support beams rot away inside. Stage 3, the trigger. Never the cause, just the spark. A rate hike, earnings, miss war, or credit event. Specifics don't matter. What matters is the buyer vanishes. Without new suckers, the leverage scheme implodes. Margin calls turn selling from a choice into a mandate. Forced liquidation feeds on itself. Liquidity evaporates exactly when you need it most. Stage 4, the crash. Not a moment, but a grind. Waves of dumping, violent bounces, false hope. Eventually, total exhaustion after massive paper wealth destruction has already occurred. This pattern has never failed. In 2026, we are no longer guessing where we sit within it. To know where we are, stop forecasting and start seeing patterns. Markets don't crash from bad news. They crash from systemic fragility. And fragility always reveals itself the same way long before paper prices collapse. Look back. In 1929, the herd believed industry rewrote economic laws. In 2000, the internet. In 2008, housing scams. Each era had a story, but the structure was identical. Extreme optimism, sick leverage, and total confidence that the risks were contained. Today's narrative is AI, passive flows, and central banks as a permanent backstop. Different jargon, same psychology. In every case stage, 2 lasted longer than expected. That is why investors get trapped. The market doesn't punish excess, it rewards it enough to suck everyone in. New highs prove warnings wrong. Skeptics capitulate. Caution feels too expensive. As prices drift up, something critical shifts underneath. Liquidity thins out. Positioning gets crowded. The market's ability to absorb shock quietly vanishes. When that happens, stability becomes a total illusion. This is when pros stop talking and start acting. Exposure is cut. Protection added. Risk is dumped from banks to retail long-term investors. No announcement made, no alarm sounds. Alarms destroy their exit liquidity. What makes this cycle dangerous is speed. Tech compresses time. Algos don't hesitate. Passive flows don't think. When selling starts, it doesn't ask, it executes. That is why modern crashes feel sudden, even though conditions took years to build. Right now, the market hangs on confidence alone, not growth, not earnings, not fundamentals. Confidence, and confidence is the most unstable asset in all of finance. Once that cracks, it doesn't bend, it shatters. Many investors hear warnings and dismiss them with a familiar coping line, "We survived 2008. That is comforting, but dangerously misleading. Conditions in 2006 are not safer than 2008. They are far more extreme. Start with valuations. In 2008, the market entered the crisis with high prices, but today's multiples are significantly higher. When priced for perfection, small misses create massive damage. The higher the start, the deeper the fall to restore balance. Now look at leverage. In 2008, margin debt was huge. Today it's historic. Borrowed fiat magnifies gains up and forces liquidation down. Leverage doesn't ask for patience. It demands action at the absolute worst moment. Then there is concentration. In 2008, the index was diversified. Today, performance is dominated by a handful of massive companies. This creates a single point of failure. When leadership breaks, there is nothing underneath to catch the fall. Now add passive paper investing. Trillions of fiat dollars move mechanically, never strategically. Index funds ignore intrinsic value. They buy when currency flows and selling when it flows out. When selling pressure spikes, these vehicles accelerate the drop rather than absorbing it. Finally, look at herd behavior. Retail gambling has never been higher. Millions holding paper with zero experience are one click from panic selling. Social platforms amplify the fear faster than any bullion dealer or financial channel could. In 2008, fear spread via headlines. In 2026, it spreads instantly through phones. This is why the next crash won't resemble the past in the speed or intensity. The fiat system is tighter, faster, and far more fragile. Fragile paper systems don't correct gently. They fail suddenly. Collapses never start with certainty. They start with pressure. Pressure builds quietly and visibly until the rigging can no longer mask it. By the time news catches up, the wealth destruction is underway. That is exactly where we are now. Multiple triggers are stacking up at the same time, and that's what makes this moment especially dangerous. Any single one could cause instability. Together, they create a massive chain reaction. First, the global liquidity shift. For years, cheap fiat acted like oxygen for paper assets. That oxygen is being slowly withdrawn. Higher rates don't break markets overnight, but they change behavior. Borrowing gets costly. Refinancing dries up. Risk tolerance shrinks. Leverage that once felt manageable becomes totally suffocating. Second, forced positioning. When too much fiat crowds into the same trades, flexibility vanishes. Everyone holds the same paper stocks. Everyone believes the same narratives. When prices begin to fall, there are no natural buyers, only sellers competing for the exit. Third, earnings reality. Markets can ignore real fundamentals for a while, but not forever. When growth slows and margins compress, stories lose power. Expectations reset violently. Stocks don't fall because earnings dip. They fall because the future suddenly looks smaller than what was priced in. Fourth, geopolitical instability. Markets hate uncertainty more than bad news. Conflict, trade disruption, and political risks introduce variables that models can't price. When uncertainty rises at market peaks, risk premiums expand fast and paper prices fall to compensate. None of these triggers need to explode all at once. They just need to destroy confidence. Once confidence breaks, leverage unwinds, algorithms react, and panic selling becomes self-reinforcing. At that point, the market doesn't ask whether selling is rational. It only asks whether the positions can survive. Most simply cannot. The most misunderstood part of a market crash is the speed. People imagine panic as an emotional response. In reality, the most destructive phase has nothing to do with fear. It is largely mechanical. When markets are highly leveraged, selling doesn't begin because investors want to sell. It begins because they have to. This is where theory meets cold reality. As prices fall, leveraged positions break their limits. Margin calls arrive, not as suggestions but as demands. Add fiat immediately or positions will be liquidated. Many investors can't add capital, so assets are sold off regardless of the price. That forced selling pushes prices lower, which triggers more margin calls, creating even more forced selling. It's a feedback loop with no emotion involved, just cold math. At the same time, algorithms respond to volatility and momentum. They don't pause to evaluate long-term value. They accelerate what's already happening. Liquidity vanishes because market makers step away when risk spikes high. Bids thin out. Prices gap down instead of moving smoothly. This is why stop-loss orders fail in crashes. They execute far below expected levels. The market doesn't fall in neat increments. It drops through empty air pockets. What makes this cycle especially brutal is concentration. When the same stocks dominate portfolios, selling becomes synchronized. Everyone exits the same doors at the same time. There's no diversification benefit when all correlations go to one. This is the moment when disbelief turns into shock. Accounts that looked healthy weeks earlier are suddenly down double digits. News anchors scramble for explanations. Analysts talk about overreactions, but the whole process is already in motion. By the time the public understands what's happening, the most violent phase is usually over. The damage, however, is largely permanent. And this is truly only the beginning of Stage 4. One of the biggest mistakes investors make is assuming a crash is a single event, a bad week, a terrible headline, then recovery. That's not how major declines work. They unfold as a process designed to wear people down emotionally and also financially. After the initial collapse, markets often bounce. These rebounds feel convincing. They restore hope. Commentators declare the worst is over. Bargain hunters rush in convinced they're buying the bottom, but these rallies are not signs of health. They're symptoms of deep instability. Each bounce is weaker than the last. Each decline goes further. Optimism slowly drains as portfolios fail to recover. What began as confidence turns into anxiety, then total exhaustion. This is where most long-term damage is done. Investors hold through the first drop convinced it's temporary. They hold through the second believing recovery is imminent. Eventually they sell not at the bottom but close to it because they really can't take the stress anymore. Meanwhile, institutions operate differently. They wait, they conserve capital, they allow prices to fall until value reappears. Crashes don't destroy wealth equally, they transfer it from the impatient to the prepared ones. Historically, this phase lasts longer than expected. 12 to 18 months is common, sometimes more. Recovery doesn't begin when prices are low. It begins when sellers are exhausted and risk is no longer fashionable at all. The irony is painful. The moment when investing feels safest, near market peaks, is the moment when risk is highest. And the moment when investing feels unbearable, near market bottoms, is when opportunity quietly returns back. Most people never experience that opportunity because they no longer have capital or true confidence left. This phase is not about predicting exact lows. It's about survival, preserving capital, avoiding irreversible mistakes, because once this process starts, patience alone is simply not enough. True preparation is what matters. As markets approach their breaking point, a familiar set of arguments always appears. These arguments don't protect investors, they trap them. And they sound reasonable precisely because they appeal to comfort, not true reality. The first lie is that central banks will step in and stop the damage. The idea of a permanent safety net is seductive, but history shows that policy actions lag. Markets not lead them. Rate cuts don't prevent crashes. They usually respond to them. And even when intervention works, it works only after enormous losses have already occurred. The second lie is that technology has changed the rules, smarter systems, better data, faster execution, but none of that eliminates cycles. In fact, it amplifies them. Speed doesn't create stability, it creates fragility. When everyone reacts faster, mistakes compound much faster too. The third lie is the most dangerous stocks always come back. This statement is technically true and practically useless. Markets recover, but investors have timelines. A 50% drawdown doesn't just reduce wealth, it reduces options. Time becomes the enemy. Retirement gets delayed. Risk tolerance collapses. Opportunity cost becomes truly permanent. Then there's the final lie: buy and hold works for everyone. It doesn't. It works for people with decades ahead of them and strong emotional discipline. It fails for those near major life transitions, retirement, education, funding, business, exits where large losses simply cannot be absorbed. Crashes don't just test portfolios, they test identity. People who believe they were long-term investors discover they were only comfortable during uptrends. When losses become real, principles quickly disappear. Understanding this isn't pessimism, it's realism. The market doesn't care what you believe, it only cares about positioning, leverage, and psychology. And right now, psychology is dangerously misaligned with real risk. That misalignment never ever resolves gently. When this cycle finally ends, the market will look nothing like it does today. Prices will be lower, narratives will be broken, confidence will be gone, and millions of investors will ask the same question they always ask after major crashes. How did this even happen? The answer will be simple. The signals were visible, the pattern was familiar, but acting early felt unnecessary until it truly wasn't. Investors who survive don't try to predict the exact day of a crash. They manage exposure before fear forces their hand. When valuations are extreme and risk is mispriced, protecting capital matters more than chasing returns. Avoiding a large loss does more for long-term wealth than squeezing out the last bit of upside now. That means accepting trade-offs. Missing a final rally is uncomfortable, but losing half your portfolio is devastating. Cash isn't a mistake in late cycle markets, it's optionality. It gives you the ability to act when others are trapped fast. True stackers know what to avoid holding. Paper trades crash the hardest. Fiat assets people think are safe rarely stay that way. Even solid stocks turn into bad holds if bought at crazy premiums. Timing the spot matters, but physical weight defines your real outcomes. Resets wipe the slate clean. They purge leverage, they crush paper arrogance, but they reward stacking discipline and grit. The biggest hoards are built by those who held on to sound money while the panicked masses were forced to liquidate. History won't predict the spot price. It warns those stacking. The cycle holds mania signals, triggers crash and reset. Only the fiat currency names and the banking lies actually change. We are not early in this debt cycle, we are late. And late-stage paper mistakes cost the most ounces in the end. If this helped you see the fiat trap, subscribe now, share with a fellow stacker, and comment. Silver below. Next, we will cover how to guard your stack, find the floor, and position for the massive wealth transfer that only happens after the debt system finally resets. Spot prices fluctuate. History rhymes. Holding physical makes the difference.